Welcome back to Financial Cake, your go-to channel for slicing through the complex world of finance. Today, we're dissecting one of the most audacious financial crimes in history. We're talking about a fraud so massive, it vaporized $64 billion and shattered the lives of thousands. This is the story of Bernie Madoff and the anatomy of his colossal Ponzi scheme. So, how did one man trick the world's most sophisticated investors for decades? Let's break down exactly how this scheme worked, the psychological tricks he used, and the glaring red flags that everyone, from regulators to investors, completely missed. You won't want to miss this. Imagine a financial wizard, a former chairman of the Nasdaq Stock Exchange, a man who seemed to have the Midas touch. This was Bernie Madoff. He promised steady, consistent returns of 10 to 12% every single year, whether the market was soaring or crashing. To his exclusive list of clients, this wasn't just an investment, it was a golden ticket. It was a sure thing in the unpredictable world of Wall Street. Madoff's firm, Bernard L. Madoff Investment Securities, became a beacon of stability and wealth. But behind this facade of success was a lie of monumental proportions. There was no secret trading strategy. There were no brilliant investments. Madoff was running the largest Ponzi scheme in history. So, what exactly is a Ponzi scheme, and how did Madoff pull it off with such devastating precision? At its core, a Ponzi scheme is deceptively simple. It's a fraudulent investment operation that pays returns to earlier investors using capital from newer investors, rather than from legitimate investment profits. Think of it like a leaky bucket. Madoff promised investors their money was being put into a sophisticated strategy called a split-strike conversion. He claimed to be buying a basket of large, stable stocks and then using options to hedge against market downturns, generating profits while limiting risk. It sounded brilliant, plausible, and incredibly technical, which was part of the genius. It was just complex enough that most people wouldn't question it, especially coming from a Wall Street legend. But here's the reality, none of that was happening. When a new investor, let's call her Jane, gave Madoff $1 million, he simply deposited it into a bank account. He didn't invest a single penny of it. Then, when an earlier investor, let's call him Tom, wanted to withdraw some of his profits, Madoff would just take the money from Jane's initial investment and give it to Tom. The system relied on a constant flow of new money to pay off the old. As long as new cash coming in was greater than the money going out, the illusion could be maintained. Madoff produced fake, paper-based trading confirmations and account statements that showed his clients' accounts steadily growing. These documents were pure fiction, fabricated to support the lie. The mechanical side of the scheme was one thing, but Madoff's true dark genius lay in his mastery of psychological manipulation. He didn't just sell an investment strategy, he sold trust, exclusivity, and a sense of belonging to a very special club. First, there was the illusion of scarcity and exclusivity. You couldn't just walk in off the street and invest with Bernie Madoff. You had to be invited. You had to know someone. This created an intense desire to get in. People felt privileged and special to be included, which blinded them to the need for due diligence. They were so desperate to join the club that they didn't dare ask too many questions for fear of being turned away. Madoff understood human nature. He knew that people trust who they know. He leveraged a network of feeder funds, smaller investment firms that would pool money from their clients and invest it all with Madoff. These funds were run by people who were pillars of their communities, further extending the web of trust. He cultivated an aura of a humble, family man who wasn't flashy or greedy. He wasn't some wild Wall Street trader, he was a stable, reliable figure. This persona made him seem trustworthy and disarmed even the most skeptical individuals. He was the ultimate gatekeeper. If you questioned his methods or asked for too much transparency, you risked being kicked out of this exclusive circle. The fear of missing out, or FOMO, was a powerful tool that kept his investors compliant and quiet. With a fraud of this magnitude, you'd think there would be red flags everywhere. And there were. The problem was, people either didn't see them, or more disturbingly, chose to ignore them. The biggest red flag was the consistency of the returns. No legitimate investment strategy on earth can deliver a steady 10 to 12% return year after year, regardless of market conditions. The stock market is volatile, it goes up and it goes down. Madoff's returns seem to defy financial gravity. Some competitors and financial analysts did notice this. They tried to replicate Madoff's split strike strategy and found it was mathematically impossible to generate the returns he claimed. The volume of options trades he would have needed to make simply didn't exist on the market. Another massive red flag was the complete lack of transparency. Madoff's firm acted as its own broker-dealer and its own custodian. In a normal investment setup, these roles are separated to provide checks and balances. One firm executes the trades, and another independent firm holds the assets and sends out statements. Madoff did it all in-house. All the trade confirmations and account statements came from his firm, not a neutral third party. This allowed him to fabricate everything without any outside verification. The auditing firm he used was a tiny, unknown 3-person operation in a strip mall, which was absurd for a multi-billion-dollar fund. The Securities and Exchange Commission, or SEC, the very body designed to prevent such fraud, investigated Madoff multiple times over the years. Whistleblowers, like financial analyst Harry Markopoulos, repeatedly handed them detailed evidence proving it was a Ponzi scheme. Yet, time and again, the SEC failed to uncover the fraud. They were either intimidated by Madoff's reputation, lacked the financial sophistication to understand the complaints, or simply didn't dig deep enough. They took Madoff's fabricated documents at face value and closed their investigations. Like all Ponzi schemes, Madoff's empire was destined to collapse. The end came swiftly with the 2008 financial crisis. The global market meltdown caused a wave of panic among investors. Suddenly, everyone wanted their money back at the same time. Clients requested withdrawals totaling around $7 billion. But the money wasn't there. The constant inflow of new cash had dried up due to the crisis, and the bucket was finally empty. There was no more new money to pay off the old investors. The lie could no longer be sustained. In December 2008, a cornered Bernie Madoff confessed to his sons, Mark and Andrew, who worked at his firm but were allegedly unaware of the fraud. He told them his investment advisory business was one big lie. His sons immediately went to the authorities. The next day, Bernie Madoff was arrested, and the world's largest Ponzi scheme came crashing down. The fallout was catastrophic. Thousands of investors, including charities, universities, and retirees, lost everything. They had believed their life savings were safe and growing, only to find out it was all an illusion. The paper wealth they saw on their statements had never existed. The Madoff scandal is a brutal lesson in the psychology of trust and the dangers of greed. It shows how a charismatic figure can exploit our deepest desires for security and social status. It's a reminder that if an investment seems too good to be true, it almost certainly is. It also serves as a permanent scar on the reputation of financial regulators, highlighting the devastating consequences of failing to act on credible warnings. The story of Bernie Madoff is a chilling tale of deception, but it's one we must never forget. Thank you so much for joining us on Financial Cake today. I hope this breakdown gave you a clearer picture of how these devastating schemes operate. If you found this video insightful, please hit that like button, subscribe to Financial Cake, and ring the notification bell so you never miss a slice of our financial analysis. Drop a comment below with your thoughts or any topics you'd like us to cover next. Until then, stay curious and invest wisely.